Debits and credits are a fundamental accounting concept that is often quite difficult to understand for new accounting students. In part one, which I linked above, I covered the 5-step process that accountants go through in determining what accounts to debit and what to credit. I recommend that you watch that video first before watching this video, where we'll continue to practice the concept of debits and credits with additional examples. Let's look at this business transaction. The business purchases office furniture for $5,000 from Staples. Step one is to determine if a business transaction even exists. Lots of things happen in a business, and not all of them are business transactions we need to record. An example of a business transaction that accountants don't need to post in the accounting ledgers is when the marketing team develops a new marketing campaign. Of course, it's an important process, and accounting should know about it because likely there will be new commercials on different media platforms, but there isn't, at least yet, a transaction accountants would record. So how do we figure out if, as accountants, we need to record a transaction in a journal? We go through the following questions. We ask, what happened? In this example, the business purchases office furniture for $5,000 from Staples. Is it related to the business? Yes. Can you value the transaction, meaning is there a dollar amount? Yes. The dollar amount is $5,000. Do you have support for the transaction? Yes. The business has the receipt from Staples for $5,000. We answered questions 2 to 4 with a yes. And based on this information, we can determine that this is a business transaction that we need to record in our general journal. In step 2, we now determine what accounts increased and/or decreased. Every transaction must have had at least 2 parts. That is why accounting is also called double entry bookkeeping. So for our example, the furniture account increased because the business now has more furniture. The business also paid cash for the furniture, and that means that the cash account decreased. So for this transaction, the furniture account increased and the cash account decreased. That already brings us to step 3, where we need to decide what type of account categories the accounts that we identified in step 2 fit into. We can choose from asset, liability, equity, revenue, expense, or drawing or dividend account. So what do you think? What type of accounts are impacted by the transaction in this example? Yes, furniture is an asset. Why an asset and not an expense? Furniture benefits the business over multiple years, and instead of recording an expense when we purchase the furniture, we record the amount initially as an asset and then slowly, over a period of a few years, move the amount from the asset account to the expense account. We call that process depreciation. But back to our transaction example. So furniture is an asset. What about the cash part of our transaction? What category does cash fit into? Is it something that the company owns? Yes, that is why cash is an asset as well. So the transaction only impacts the assets of the business. One increase to the assets and one decrease to the assets. In step 4, we're now ready to apply the dealer mnemonic. On the left side, for the first 3 letters of the word dealer, we have drawings or dividends, expenses, and assets. These are categories of accounts which increase with debits. Do these accounts only increase with debits? No. If these categories decrease, they decrease with credits. On the other side, the right side, we have the last 3 letters of the dealer mnemonic, LER. L is for liability, E is for equity, and R is for revenue. These type of accounts increase with credits. Now for our transaction, we determined in step 3 that furniture is an asset. The dealer mnemonic tells us that asset accounts increase with debits. So that means that because the business's furniture has increased, we need to debit the furniture account. Okay, so we figured out the debit part for our transaction. And remember, we need at least one debit and one credit for every transaction we record. In our transaction, the cash account decreased. And in step 3, we figured out that cash is an asset. Assets increase with debits. And in our case, we need the account to decrease. So we do the opposite. We credit the account. So credit cash, debit furniture, and credit cash. In step 5, we can now record the entry. We debit the furniture account for $5,000 and we credit the cash account for $5,000. And as the final part of step 5, we double check our work. What account was debited? The furniture account, because furniture is an asset that the company owns, and when an asset account increases, it is debited. What account was credited? The cash account, because cash is an asset, and assets increase with debits and decrease with credits. Is there at least one debit and one credit? Yes. Do the total debits equal the total credits? Yes. Now let's see how this transaction impacts the accounting equation. We want to make sure that the fundamental accounting equation still holds true. Furniture is an asset and it increased the asset side of the accounting equation by $5,000. Cash is an asset account and it decreased by $5,000. So a plus 5,000 to the asset side on the left side of the equation and a minus 5,000 on the left side of the equation, and that means that the net impact is $0. Let's add this transaction to our list of accounting transactions that we started in part 1 of learning debits and credits. In this next example, the business purchases equipment for $2,000 from Business Warehouse Inc. on credit. Let's walk through this exercise step by step. In step 1, we ask ourselves 4 questions to determine if this is a business transaction we need to record. Question 1 is what happened? The business purchased equipment for the business. Question 2, is it related to the business? Yes. Question 3, can you value the transaction? Meaning, is there a dollar amount? Yes, the dollar amount is $2,000. And question 4, do you have support for the transaction? Yes, the business has the receipt from Business Warehouse Inc. for $2,000. Based on having answered yes to questions 2 to 4, we can tell that this is a business transaction that we need to record. In step 2, we now determine what accounts increased and or decreased. First, the equipment account increased because the business now has more equipment. The business did not pay for the equipment and instead incurred in accounts payable. Promise to pay later. Those promises to pay later, the accounts payable is a liability for the business to a vendor. In this case, Business Warehouse Inc., and the accounts payable increased. So equipment increased, the liability account called accounts payable also increased. Now in step 3, we now determine what type of accounts are impacted by the transaction. What type of account is equipment? What type of account is accounts payable? Equipment is an asset and accounts payable is a liability account. So assets are impacted and liabilities are impacted. Now let's use the dealer mnemonic. It's very small here, but you can probably visualize it. The first 3 letters stand for drawing or dividend, expenses, and assets. These accounts are increased with debits. The last three letters of the dealer mnemonic stand for liability, equity, and revenue. These accounts increase with credits. So for our transaction, we determined that equipment is an asset and assets increase with debits. So we need to debit the equipment account. What about the second part of our transaction? Because double entry bookkeeping, the accounts payable account increased, and we determined that accounts payable are a type of liability account. And liability accounts increase with credits. So credit accounts payable. Are you ready for step 5 to record the entry? We debit the equipment account for $2,000, and we credit accounts payable for $2,000. And we can double check our work. Did we debit and credit an account? Do the total debits equal the total credits? Yes. Does the fundamental accounting equation still hold true? Equipment is an asset on the left side of the accounting equation. It increased the asset side of the accounting equation by $2,000. Accounts payable is a liability account, and it increased by $2,000. So a plus $2,000 to the asset side on the left side of the equation, and a plus $2,000 on the right side of the equation. And you can see that the left side of the equation is $2,000 and the right side is $2,000, which means that the accounting equation still holds true and balances. Let's add this transaction to our list of accounting transactions as well. Let's try this example. Remember that the business just purchased equipment for $2,000 from Business Warehouse Inc. on credit. We recorded a debit to equipment to increase our assets and a credit to accounts payable to increase our liabilities. Now the business pays the money owed to Business Warehouse Inc. of $2,000. Step 1. Is this a business transaction we need to record? What happened? The business pays a debt owed in cash. Is it related to the business? Yes. Can you value the transaction? Is there a dollar amount? Yes. The dollar value is $2,000. Do you have support for the transaction? Yes. The business has a receipt from Business Warehouse Inc. for $2,000 and the check stub or wire transfer to Business Warehouse Inc. Based on this information, we can tell that this is the business transaction we need to record. In step 2, we now determine what accounts increased and or decreased. First, the accounts payable liability account decreased because the business now paid its debt. And how was the debt paid? It was paid with cash. So the business's cash decreased. There you have it. Decrease to accounts payable and decrease to cash. In step 3, we determine what type of accounts are impacted by the transaction. What type of account is accounts payable? What type of account is cash? Accounts payable is a liability account and cash is an asset account. So liabilities are impacted and assets are impacted. Now let's use the dealer mnemonic to identify whether we need to debit or credit. First, accounts payable accounts are liabilities that are on the right side of the dealer mnemonic because liabilities, equity, and revenue stand for the last three letters of dealer. Liability accounts increase with credits, but in our case, we're not looking for an increase because our liabilities decreased. How do these type of accounts decrease? Exactly, with a credit. So debit accounts payable to decrease the liability. What about the second part of our transaction? The cash account decreased, and we determined that the cash account is an asset account. And do you recall how asset accounts increase? The first three letters of the dealer mnemonic stand for drawing or dividends, expenses, and assets. And these type of accounts increase with debits. But the cash account didn't increase, it decreased. So we need to credit the cash account. So debit accounts payable and credit cash. Are you ready for step 5 to record the entry? We debit the accounts payable account for $2,000 and we credit cash for $2,000. And we can double check our work. Did we debit and credit an account? Yes. Do the total debits equal the total credits? Yes. Does the fundamental accounting equation still hold true? Accounts payable is a liability account and it decreased by $2,000. So minus $2,000 to the liability side, the right side of the equation. Cash decreased. Cash is an asset on the left side of the equation. So minus $2,000 on the left side of the equation. And you can see that the left side of the equation decreased by $2,000 and the right side of the equation went down $2,000, which means that the accounting equation, assets equals liabilities plus owner's equity, still balances. Let's add this transaction to our list of accounting transactions as well. This brings us to the end of part 2 of the series Learning Debits and Credits. Please continue with part 3 where you learn 4 additional accounting transactions step by step.